Hey everyone, Bill here from Envision Trading. Following on from our last webinar, today we're going to talk about liquidity and supply and demand. You will actually begin to see how all these concepts go hand in hand from the first webinar to this one and the future webinars. Let's start with supply and demand. Richard Wyckoff identified supply and demand, and he actually wrote a book on the subject where he came up with 3 laws of price, which are characteristics of the nature of price. The first is supply and demand. So as you can see up here, the second is cause and effect, and the third is effort and result. The first law we're going to talk about is supply and demand. Firstly, we need to remember that demand is the bottom and supply is the top. These two, demand the bottom, supply the top. We're trending long. We will be breaking supply of the said break of structure, and demand is in control. So we're breaking supply, tapping back into demand zone, breaking supply, tapping back into demand zone, like this. Okay, then continuing long. If we're selling, we are breaking demand and tapping into supply. Break demand, tap into supply, break demand, and so on. With looking at supply and demand, we need to look at cause and effect. Banks will contain price in a range like this. This is cause for lower prices. So it's liquidity. It's a build-up of buyers and sellers. So there's lots of stop losses under here, and there's lots of stop losses up here. So they'll initiate a direction, take out the stop losses of all, in this case, all the buyers, and then they've initiated their direction. We'll get the mitigation, and that is the result. Okay? That sums up these 3 laws of Wyckoff and how we are using them. So again, I'll just reiterate that. This is the cause, and it creates an effect, which is the move out of the range. And again, this is just the footprint of banks and financial institutions. I say banks and financial institutions as they are trading in the billions, and they're the only ones who have the accounts to be moving the market, like Goldman Sachs and JP Morgan, are just to name a couple. And we are obviously trying to get in here and getting in as we are trending. Liquidity being the build-up of buyers and sellers, let's go up here to liquidity, and we'll have a look at a couple of different types of liquidity. So we have equal or relative equal highs and lows. If we get this, like double tops and double bottoms, the banks will aggressively take out the lows and the highs, or just aggressively take out a direction and then initiate a continuation. That's just important to note. Also, after we've got a series of mitigations or a trend, let's look at this drawing here. It creates liquidity for future direction. After we've had a series of mitigations, that will eventually get run or get used for future direction, and then we'll continue in the opposite direction. So this is just an example of that. So we have a descending channel or series of sell mitigations. Then they'll impulse up and continue price going up, or that'll mitigate and then go back down. They're just doing liquidity sweeps. Same with here, sweeping liquidity. Another good way of looking at it, let's move over here, is looking at it as in internal and external liquidity. So we're trending up, we're creating internal liquidity, it gets taken, and when it gets taken out, when the internal liquidity gets swept, we've created external liquidity, then it gets swept. And while sweeping the external liquidity, we've created more internal liquidity for it to get swept. Now I'm going to show you guys and girls some examples of this. What we're going to do, we're just going to go through the charts a little bit and identify where liquidity has been built and where it's been taken out. And we're also going to identify some supply and demand zones to just see how it all works. Let's start with here. All right, let's mark this up. What happened here? We broke structure, we came right back around and tapped into demand. Okay, so if we're buying, we're tapping into demand, we're going long from demand, and we're reacting from supply. Okay, so we break this high, so our expectation is for it to pull back and go long again. Also, where is the liquidity? This is liquidity. That's the trend line, and we pushed through. This is liquidity. So we tapped into this, we created liquidity, so we created cause to drop and then push up. We'll go through some more examples. Let's just keep going through and have a look. What have we done here? There's a big range here. There's the high, there's the low. This is supply. So we've broken structure here, tapped back into the bottom, back into demand. So we've broken structure, so the supply is causing the pullback to then go up again. Break structure again, drop back down. On this time frame, that's the range. Same again, broke structure again, tap down into demand. All of these are demand zones. And what do they create? This is all liquidity for a future move down. And now let's look at the liquidity inside here. Let's actually mark it on. I mark it on with these red dots. So we have liquidity there. And what did price do? It created liquidity on its way down and then swiped the liquidity on its way up. Same thing here. We have liquidity, curved liquidity all here. So it correctively moved down to then take the liquidity and swipe up. So there's equal highs in here as well. Relatively equal highs that got taken out. Understanding this will make you understand why some lows and highs don't hold. For example, here, we broke this structure. Why did this not hold? Why did it go down? What do we have? We have equal lows, equal low liquidity. That got swiped to mitigate this range. And what is this range? This demand zone. And if you look left, the reason we're having a pullback is we'll be tapping into supply, okay? High of the range, low of the range, the mitigation can happen anywhere in here. It can be the edge is the first point. Very common is the 50% as well. But just anywhere within there is a mitigation. Let's get going. While creating this, we created again equal highs. We mitigated this range. We left liquidity on the way down. Even there's a bit of trend line liquidity as well. There will be, what are we on? We're on the hourly, and there'll be liquidity on other time frames as well. We left liquidity for the future move up and created liquidity here for this mitigation. Now we have another range, or another what? Another demand zone. All right, it never got mitigated. We dropped, we went right up, never got mitigated. So a good spot for buying is the edge of here, okay? And why did we pull back? Again, if you look to the left, there'll be another range, another supply over there, creating our pullback. Let's have a look at this. What happens? We broke structure here, broke to the upside, and this didn't hold. So we actually have demand here. There's a demand zone. Why did it not hold? The range below had not been mitigated yet. Liquidity was created to mitigate this range way over here. We created liquidity there, and even prior, look at this. Liquidity there, liquidity gets taken, mitigates supply over here, drops back down, breaks structure again, takes this liquidity, mitigates this range, and then goes up. Break structure, we do have demand here, so a demand zone there. So we break structure, tap into demand, we have a reaction, tap back into demand, have a reaction, and in turn, we create liquidity. Let's mark it on in the red. We create liquidity. So when we have equal lows, we normally get aggressive runs through it. So we broke structure again, and we just went straight through this liquidity. And if you're looking for buys here, you need to be careful because there's equal lows here. over here, we left liquidity as well. You can see it, buying and selling, it's a bit of a range. And that liquidity was left for a deeper mitigation of this range. And then as we dropped, we created more liquidity for then price to run straight through it. Then again, we create liquidity there. So later on, price will go back and take that liquidity. This is just how it's operating. I will say this is demand as well. Again, referring to it being internal, external liquidity. We've left a lot of internal liquidity here. It gets taken, and in the process, it's left all of this external liquidity. Then the external liquidity gets taken, and then it leaves internal liquidity. All right, let's go back down to our drawings. So you can mark liquidity as LQ, or you can just put a $ as well, because what you need to know is that there's a lot of money sitting at highs and lows. So you can mark it with LQ for liquidity or a $. Let's go to the lower time frames where we'll just go to somewhere recent. We'll go bar replay. It's the exact same on all time frames. What are we on now? We'll go to the 5 minute. Often you'll get liquidity built up to mitigate a range. Okay, so I can see that here. We have a range here. We have highs. Okay, so price broke structure, it left this liquidity to mitigate this range to continue. We have a break of structure, price pushes back up, mitigates supply. So let's put that in. We need to remember it's supply. So because we're selling now, supply will be holding and demand will be breaking. So this was demand. It failed or it broke. So we're going down. Okay, so again, break of structure, we drop all the way down. So once we drop down, even before price, we have a range here. So that's our supply. Supply, we break structure to the downside and we go all the way back up, mitigate our range. So these are the banks initiating sells and they're going up, mitigating and continuing price. And these are lower time frame mitigations here. And these are entries in here. It looks like it's familiar and I took sells in here actually. So what happens? What did we create when we moved up to mitigate the supply? You can see it, liquidity. And then that's going to get run, which it does, as you can see. So then we have a break of structure, we drop. And what do? We just go sideways. And why do we go sideways? We're building liquidity to just get taken. Building liquidity, get taken. Then we descend. So again, that's building liquidity for what? For this mitigation. Okay, I should be drawing in all these supplies as well. So we have supply there. We have supply there. And as you can see, we're just dropping. The banks are initiating sells up here. They're pulling back into premium prices, then drop again, pulling back into the supplies and mitigating sells. And again, you can just keep following it. And this is just how the market moves. Liquidity gets taken. We descend a little bit. And again, just look at all these ranges. So you just measure, like mark out the top, mark out the bottom. Same story here. I can tell on a lower time frame that's a range as well. And the same thing. So what do we see? Break of structure. This candle mitigates this range. So now this range has done its job. So you look for sells. So you sell here. Creates liquidity, mitigates this range or this supply, and this cycle keeps on going. And even here, like what's this? See how it descends a little bit? So what do you think will happen? That's a little bit of liquidity. So if I just play it forward, this would be funny if it doesn't work. There we go. It took out that little bit of liquidity. And what did that? So that's the cause for what? The cause for this mitigation of the range. And the cycle just keeps on going. I'll leave it at that for today. So I hope you've all learnt something And if you would like to go deeper into our entries of what we are taking on a daily basis, you're welcome to join our Discord. I'll put the link in the bio anyway. Alright, guys and girls, have a good day and happy trading.